Hi there. Welcome to Market Call. I'm Lindsay Biscaya. Stan Wong is on the show today. He is a portfolio manager at Scotia Wealth Management, and he will be taking your questions on North American large caps and ETFs. This is how you can reach us. You can call us toll free, 1-855-326-6266. You can also email us at marketcall@bnnbloomberg.ca. Good to have you in. Nice to meet you.
Great to be here, Lindsay. Nice to meet you.
Okay, so it's been a wild ride over the summer. September sometimes slows down, but it looks as though you're optimistic about the next couple months ahead. We've got a jobs update in the U.S. coming tomorrow, possibly rate cuts. What are you looking for this September?
Well, September historically tends to have some weaker seasonality. If you look at the last 10 years, the average return for September for the S&P 500 is about negative 2%. And 6 out of the 10 Septembers in the last 10 years, again, have been negative. With that being said, I mean, we've really seen a strong momentum going into September with 4 straight months of gains in the market. Earnings have been good. The S&P 500 Q2 earnings were up 13% year over year, with 81% of companies beating estimates. And analysts going forward see about a 12% growth for 2026. So really that lays the groundwork for continued gains going forward. And then you add to that, there's been about $1 trillion in stock buybacks in the U.S. and liquidity, $7.2 trillion sitting in cash in the U.S. That's a lot of dry powder. That's going to be a powerful tailwind potentially for equities, especially if we see interest rates drop, which I think there's a 90-something% chance of a Fed cut later this month, and then there was a 60% chance of a Bank of Canada cut. So I think the groundwork for equities to continue moving forward and upward, trending higher is still there. But, we might see a little bit of volatility in September, just given the fact that we've had a very strong 4 months and the fact that September seasonally is a little bit weaker.
There is some uncertainty right now and some concern from some people about, down in the States, the Federal Reserve remaining independent. Obviously, President Donald Trump is kind of pushing for a lot of things there, including rate cuts. Are you concerned that other people, investors, might be concerned about what's happening there, or do you think that's not going to make it much of a difference? Certainly
the independence of central banks is important. I think that's why we've seen a little bit of weakness in the U.S. dollar for the past year or so relative to other currencies, maybe not so much the loonie, although the loonie is higher against the U.S. dollar so far this year. But certainly that policy uncertainty has been something to consider in the U.S. But when you look at this market, especially with the drive from technology and AI themed type of stocks, the market continues to be strong.
Okay, and talking about that, that's what you like, right? Technology, finance, healthcare, those are some of the sectors you like to invest in.
Yes.
Is that the same thing going forward?
I do. I would add into that industrials as well and some communications, which is, in a way, technology names as well.
Any other sectors you're kind of particularly partial to or looking at as we head into September?
I would say those few: financials, technology, industrials, healthcare are kind of the ones that I'm particularly focused in. Some of the other sectors would be a little bit more defensive or too defensive. So those would be the 4 or 5 sectors I'm looking at.
Okay. And we will be right back with Stan Wong of Scotia Wealth Management, taking your questions on North American large caps and ETFs. This is how you can reach us. We're going to take a short break. We'll be back right after this. Welcome back. We are going to go right to the phones now. Ted is calling in from Newcastle, Ontario. Hi, Ted. What's your question?
Hi. May I get your view on Imperial Oil? And why doesn't it have a following like all the other majors? Thank you.
Okay, thank you. Imperial Oil, what do you think about that stock?
Yeah, thanks for that question. So yes, you're right. Imperial Oil is often overlooked. People focus on Suncor and C&Q and so forth. We don't have a lot of energy names in our portfolio right now just because of the weakness in the oil patch and sort of the crude oil prices. With that being said, Imperial Oil's chart looks a little bit more attractive than many other energy names. You can see that the prices have been moving up a little bit since the April lows, and also the 200-day moving average has been pretty steady. Alongside of that, we're getting a decent dividend of about 2.4%, and that dividend looks to be maintained and should be fairly solid. So of the energy names, Imperial Oil does look attractive from a technical perspective. We see the dividend remaining pretty stable going forward, but it's just the overall macro environment with oil prices being in the 60s and the fact that OPEC is being a little bit more open with their supply as well, hasn't really led us to the energy patch.
So you're saying maybe you wouldn't buy right now? Is that your consensus?
We don't have any energy names in our portfolio currently, just because of those reasons, those macro pictures, and the fact that globally the world is still concerned about some sort of a slowdown, which may or may not occur, but really that's reflected in crude oil prices today.
Okay, we're going to go to Tara now, calling in from Sierra Vista, Arizona. Hi.
Oh, hello, and thank you for taking the call. Mr. Wong, my question is on Adobe, the digital media software company. Obviously, AI, artificial intelligence, is causing problems for them. But I'm a long-term holder, and I'm wondering, do you think they can sort of overcome it, this artificial intelligence Wild West situation? Because they actually have legitimate software, so when you create images, it's legitimate. Your comments, please.
That's a good question.
Yeah, great question. When you look at the valuations, Adobe actually looks fairly attractive. The valuations are rather low relative to other mega cap technology names. However, when you look at the chart doesn't speak to a positive purchase at this point, just given the fact that for the better part of the last year or so, you're seeing a falling stock price with lower lows and lower highs, and the stock price is below a falling 200-day moving average. So from a technical perspective, that's really kept me away from this particular name. And then on top of that, every announcement that they've sort of come out with in the past year or so is met with disdain from the investment community, in that they're just not there in the artificial intelligence segment, so they haven't really built up enough.
Is that a problem, do you think, going forward? I mean, with the boom we're seeing with AI right now, some say the forecast is we've seen the peak of it, but do you think that's a problem that they're not really involved?
I think that the market really wants to see the AI segment being a part of most technology companies, whether or not it's Amazon, Google, Microsoft, et cetera, and Adobe's one of those names as well. So I think it is a problem for now. Whether or not they turn around in the future, hard to say at this point, but for the time being, the stock price is telling us that, from a technical perspective, investors are staying away.
Okay. John calling in from London now. Hi, John.
Hello, Lindsay. You'll forgive me if my Basque is rusty. Hello, Stan. Thanks for all the past suggestions. I've been trying to take some profit in Celestica. The stock is going crazy. Do you think I should just hold? Should I add, or should I sell a call? I don't know where I would set the strike price. Looking forward to your opinion. Thank you.
Yeah, it is climbing quite a bit, Celestica.
Yeah, Celestica, brand new high today, trading at 35 times forward earnings, with still a fairly attractive growth expectations going forward, with 43% growth expectation this year for earnings, 22% 2026, and 17%. So high double-digit type of growth expectations. Certainly, the EMS market continues to be very, very strong. If you hold the stock, I think you might want to continue to hold it. If you're looking to enter this name, I would say that it's pretty close to being overbought with a 64 RSI relative strength index. So maybe wait for a bit of a pullback, especially given the fact that we're in the midst of September now.
Okay. Michelle calling in now from Vancouver. Hi, Michelle.
Hi, Lindsay. Can I get Stan's analysis on CrowdStrike? It seems to be lagging lately. Do you see any potential upside? Thanks for taking my question.
Okay. Thanks, Michelle. CrowdStrike.
Thanks for that question. I really like the cybersecurity theme, because cyber threats will only grow in the future, and they'll only get more costly. And while companies and governments and organizations sometimes will spend a little bit less at certain times because of budgets and so forth, it's going to be more costly for them not to be using companies like CrowdStrike and Palo Alto and Fortinet and so forth. CrowdStrike is a name that we've been in and out of just trading it because it is a fairly volatile stock. I see right now that the stock has dropped down to the 200-day moving average, which historically has provided some support. So at least from a trading perspective, I think there is a possibility for a little bit of a rebound here. Most of these names are always going to trade a little bit higher. The premiums are going to be a bit higher. CrowdStrike, for example, is trading at 98 times forward earnings. You're getting a 17% earnings growth rate. So any of these names, you're going to be paying a bit of a premium.
Okay. Well, we will be back with Stan Wong right after this quick break, taking more of your questions. Stay with us. We'll be right back. Welcome back. We're going to start with an email from Steve. Steve writes, "Hi, Stan. I'm a holder of PPL. What are your thoughts on this stock going forward?" I'm assuming PPL, Pembina Pipeline, have a couple questions on that stock this week.
I wasn't certain about that one, but actually I thought it was more about PPL, the utility company in the U.S.
Okay.
So I'm not sure which one it is, so I'll answer the PPL in the U.S. if that's okay. I know that a little bit better. Certainly with AI and grid expansion tailwinds, it's helping this electricity and utility company in the U.S. 10 years ago, we wouldn't have thought of utility companies being part of this AI data center technology demand. And that's what's happening. There's rising electricity from data centers powered by artificial intelligence. PPL has a collaboration with BlackRock Infrastructure, which has helped the company as well. You're getting a 3% yield, and the stock price, as you can see, has been moving nicely with higher highs and higher lows and above the 200-day moving average. So you're getting a little bit of positive effect from AI and data centers. You're getting a 3% dividend yield, and you've got that collaboration with BlackRock. So I do like this name.
Okay. We're going to go to the phones now. Kevin is calling in from Belleville, Ontario. Hi, Kevin. What's your question? Oh.
Hello?
Hi, Kevin. What's your question?
Hi, my question is on CNQ.
Okay.
Sure.
CNQ.
Sure.
We'll take a look at the chart here. Canadian Natural Resources.
Yeah.
It's looking pretty steady at the moment.
Yeah. I mean, the stock, like many energy names, has basically been a bit of a downtrend for the past year or so. For this particular stock, you won't see it on screen, but the 200-day moving average has been falling, and the stock price has been consistently under that 200-day moving average. So for me, it's a little difficult to own a name which technically is not meeting some of my factors in the technical space. I think the dividend remains pretty steady, and you'll continue to get that dividend yield. You might get a bump up. Obviously, it depends on how oil prices move. But again, 5.4% yield it's a good yield. However, the stock price has not been performing well. I think, again, it's a macro environment and the fact that oil prices are, down to the 60s at this point and uncertain as to where we're going to look going forward. OPEC is not being very constrictive, so there's a bit of supply out there.
Okay. And next caller is Sam calling in from Brampton. Hi, Sam.
Hi, how are you?
I'm good. How are you? What's your question?
Not too bad. My question is on XEI versus XDIV, which would stand prefer for something that you can hold for maybe 5 years or longer.
Okay.
Thanks for taking my call.
Thank you. Start with XEI then.
Sure. XEI is actually a name that we hold in our tactical ETF strategy. You've got about 25% in Canadian banks in there, and you've got about 30% in energy names between oil and gas and pipelines and so forth. So it's a high dividend type of strategy. It's an ETF with mostly large cap names. You're getting about a 4.5% dividend yield, which we expect to continue to grow. In fact, it's grown about 8% over the last 5 years per year. Returns have been very, very strong, 16.2% over the last 5 years. So again, large cap Canadian names with a very, very nice dividend yield. Very steady, not necessarily high growth companies, but certainly very reliable earnings growth companies and very reliable dividends. And I think the other ETF was XDV.
I believe that's what I heard.
Yeah, so that one is the iShares Select Canadian Select Dividend Index ETF. I think the difference with that one is that the yield is a little bit lower at 4.2% or so. And then with that one, you're getting a bit more in the banks. You're getting about 38% in banks, 39% in banks, and a little less into the energy space.
So both sound okay. If you had to compare them, it sounds as though maybe you go.
Yeah, we own XEI in our portfolios, and I kind of like that diversification in that strategy more.
Okay. Now on to our next caller, G calling in from Calgary. Hi, G.
Hey, Lindsay, welcome to the show. Stan, thank you for taking my call. Thoughts and insight on Nike?
Okay.
Sure.
Let's take a look at the Nike stock. It's not doing bad. At this time, though, what are you thinking about Nike? Do you think that's a buy, a hold, a sell?
Yeah, I'm pretty cautious on consumer names just because we are getting a bit more mid to slightly mid-late cycle in the economic cycle. So with that being said, I mean, we do see interest rates coming down. That might be helpful to the consumer, but at the same time, we're late cycle at this point. Nike had a bit of a pop just due to optimism around the turnaround story. So the stock moved up above the 200-day moving average. You see that little spike in July. But the 200-day trend continues to move lower. So that's a concern of mine. And of course, you know, the tariff policies, where will they land? That's going to be an issue for Nike as well. And you are paying a bit of a premium for this name, 45 times forward earnings for a 15 to 19% earnings growth rate. So not a name in our portfolio. A little bit of macro concern about the overall consumer. I kind of prefer, you know, in the consumer space, I like names like Dollarama or TJX. I think that there's a little bit of downshift in spending that is happening now and will continue to happen going forward.
Okay, that might be a good segue into our next question, which is an email question coming in from Ash. It reads, "Hi Stan, would you buy Crocs right now? The stock, not the shoes, of course, but maybe a similar answer to Nike, right? Like maybe not the best time to invest. What do you think?"
Yeah, I don't have those shoes and I don't intend to buy any of those shoes, but you know, with respect to anybody that likes those shoes. I think there's a bit of a weak outlook for the name. I mean, if you look at Q3 guidance, it calls for a 10% revenue growth going forward. Earnings forecast going forward is slightly negative at this point. So certainly not a name that meets our criteria. We simply want to see double-digit earnings growth for companies. And then you've got this currently a 20% U.S. tariff on Vietnamese production or Vietnam production coming in. So that's going to, you know, currently costs about $90 million. Who knows where the tariffs will land going forward? But if this continues, that's going to pressure margins for a company like Crocs. And growth is just slowing. And have to wonder about the fashion trend. Some of the checks are, you know, there's a bit of a fading fashion trend for the ugly shoe boom. So not a name on our portfolio, doesn't really meet our radars.
Okay, we're going to take a quick break right now. When we come back, though, we will look at Stan's past picks. Stay with us. That's just ahead. Welcome back. We're going to go now to Stan Wong's past picks from October 10th, 2024. We'll start with Alphabet. When you picked this, it was at $162, now up to $227, 40% return, 41% total return. So it's been doing well, and also some good news for Google and Alphabet yesterday as well, avoiding some severe consequences in an antitrust case. You holding this one still? Yeah, we continue to hold it. Some of those regulatory risks are now lifted at this point, so that's good news for shareholders as well. I still like some of these large mega cap names, given that they're trading at a decent valuation. So, for example, Alphabet is trading at 23 times forward earnings. It is at a discount to other mega cap tech peers. They continue to dominate the digital ad space. And YouTube and Google search continue to also be at the top of their game as well. They're spreading AI, generative AI across search, cloud, and its workspace applications. YouTube and cloud growth is growing faster than search as well. Cloud is a little bit behind Microsoft and AWS, Amazon, of course, but of course that space continues to grow as a whole, and that market share, although the percentage may not be growing for Alphabet, the entire space is growing. So their revenues are coming in bigger, and their balance sheet, I mean, $100 billion US in cash reserves. That'll allow for more buybacks, more acquisitions, more innovation, potentially, one-time dividend payouts and so forth. And again, 23 times forward earnings is pretty cheap for a mega cap tech name. Okay, next one is Lennox, operating climate control products like heating, air conditioning. When you bought it, $595, now at $559, so 6% return, 5% total return. This is a bit of a pricier stock. Do you still have this one? We still have it. I mean, the name actually started very well, and then it kind of tailed off a little bit.
Part of that is due to the fact that a lot of money has been moving over to the technology side, right or wrong. But I think long term, there's secular tailwinds behind HVAC equipment. I mean, you look at U.S. housing activity, although, it'll go through its ups and downs, it's still moving higher. There's regulations around energy efficiency around the world in the U.S. and Canada, and those replacement cycles will continue. I had an air conditioner that broke down, couldn't fix it because there's new energy regulations in place. You have to replace it. You got to buy a new air conditioner. So that's what's happening around the world. They are a leader in their market space. They're the top player in residential and commercial HVAC. Strong pricing power. Brand recognition as well. Operating margins are above 20%, and really HVAC is a bit more resilient than your other industrial names because it is HVAC, air conditioning and heating is a necessity-driven type of industry. So we continue to like this space. I think there's a secular growth around these types of names, especially with growth into more of the emerging markets as well.
So if we just take a look at the chart again for Lennox, like it was in a bit of a dip right now, which a lot of people will see that and think, maybe it's time to buy, right? Because it's lower than it has been in the past. Is that what you're thinking for people too? Like you're holding on to this, would you suggest buying right now?
I do like it. I mean, if you look at the shorter term, 1-2 year, I mean, it's hitting some support levels that may prove to be a bit of a rebound for the stock. It had some good news, and you see that little spike back in July, and then the stock has kind of trailed off again. And of course, like money's going to move somewhere, and I think a lot of money's just gone to the more mega cap tech names, and money's moved away from some of these more boring industrial names. But with that being said, I think that some of these boring names have a lot of value behind them, and there's certainly secular growth behind a lot of these particular positions.
For sure. Okay, last past pick. This one's an ETF, iShares Core S&P Midcap ETF. When you bought it back in October of last year, it was at $61.97. Now it's $65. Return 5%. Total return up to 6%. This looks like it's been a good one.
Yeah, so this name would be in 400 mid-caps companies, again, not in the mega cap name space, not in the technology area like the S&P 500 would be. It really provides diversification. So when we talk about portfolio construction, we can't have everything in mega cap names and technology. As you may know, the S&P 500 is now about 40% technology and communication names. So it is really top heavy in those particular areas. Mid caps historically do better, have performed better than large caps and small caps over longer periods of time. So I think if we're patient with this type of space, we're seeing better valuations, potentially better returns, and these types of companies can really benefit from changes in the macroeconomic environment. So as interest rates come down, which we do expect this month from the Fed, I think the mid caps can be more flexible and take advantage of those changes. And this ETF has a very low MER at 5 basis points. So I think it's a great way to get into 400 mid cap names without taking the risk of trying to pick 2 or 3 mid-cap names.
Okay. Okay, we are going to be back with more of your questions with Stan Wong of Scotia Wealth Management, taking your questions on North American large caps and ETFs. That is just in a moment. Stay with us. Welcome back. We've got a lot more questions coming in. An email question from Peter right now. It reads, what does Mr. Wong think of gold securities and Agnico Eagle specifically? Okay, so gold obviously seeing a pretty good run right now. Agnico Eagle as well. What do you think of that stock? Yeah, certainly we've seen a spectacular move in gold. You're seeing with Agnico Eagle specifically surging earnings, surging production. EPS growth is off the charts at this point, obviously due to the fact that gold prices are hitting all-time highs.
they've got a very good asset base, good shareholder return as well. Of course, they're very exposed and levered to gold price swings. It's a little bit extended in terms of technical extension at this point, or technical charts at this point. So a little bit overbought at this point. So if you're looking to buy, maybe wait. With that being said, I personally prefer the silver market because I think that with silver, you get the added benefit of industrial demand from solar, EVs, and electronics that gold is not picking up. So I like the fact that it's not only a precious metal and it's a safe haven, but also you're getting some industrial demand as well. And when you look at that gold to silver ratio in terms of price, I think it's about 85-1 right now, which is very extended. So I think that silver might have a bit of a recovery against gold going forward. I think last time I checked, we saw a little bit of an outperformance in silver over gold, and that might continue, at least so far this year, we've been seeing that. So we could see that continue. Silver is up 40% versus gold 35% year to date.
So if Peter was asking about Agnico Eagle specifically, maybe investing in that, you'd say maybe look towards some silver companies instead?
I mean, I think it's one of the premier names in the gold space. But if I were to choose in the precious metal space, I like silver, and I specifically like silver bullion, physical silver. Obviously, there's some names in the silver space that look good, like Pan American Silver, PAAS is the name that I like. But personally, we own silver bullion ETF in our portfolios.
Okay. We'll move on now to a caller, Elizabeth, calling in from Edmonton. Hi, Elizabeth. What's your question?
Well, my question is also about gold, and some of it has already been answered. But, it's kind of easy to see why gold, even silver, is doing well in the short term. But are there any factors which will keep the gold price at these levels or even rising? And how will we know when to take profits in the Canadian gold miners?
Okay, thanks, Elizabeth. Yeah, we can keep talking about gold. I mean, is there any kind of factors that you're looking at here?
Well, I think you got to look at what's happening in the U.S. I think some of this uncertainty in policies, in policy is affecting the U.S. dollar, which is helping gold prices move a bit higher. I would express some caution about gold because gold is very, very shiny right now, and it's very popular. But I would say that if you look back to 2011 through 2016, gold prices fell over 52 months, 42%. So there is still risk with gold, as there is with anything else in the investments world. At one point, I kind of looked at potentially cryptocurrency taking a little bit of that safe haven benefit away from gold, but certainly not so far this year. Gold has performed very well, as has silver. So I don't mind the area of gold. I just think that it's a bit overextended at this point. The RSI is way off the charts here. Perhaps wait for a bit of a pullback, and do keep in mind that gold has had many drawdowns. Back in the 90s, it had a 40% drawdown, and just more recently, back in 2011 through 2015-16, it had a 40% plus drawdown as well.
And so you're saying to watch that U.S. dollar, right? If things happen to stabilize in the U.S., not sure if they're going to anytime soon, but things could bounce back.
And don't get too overweight in gold as well, because it can have volatility as well.
Okay. We're going to go on to our next caller now. Ben calling in from Kingston. Hi, Ben.
Oh, hi. Thank you for taking my call. Stan, welcome back. My question is on S&P 500 ETFs, ticker SPY, SPY. Is this now become a tradable instrument, or can we do buy and hold on it, or rather do the options on the SPY? Thank you for your outlook for near future. Thank you.
Okay, thank you. Good question. What do you think of this ETF?
Well, the spider is just the S&P 500, and I think the major concern about this particular index or this particular ETF is that it's really a technology ETF, given the fact that 8 or 9 of the top 10 names are technology names. 40% of the S&P 500 is technology or technology-oriented names as well. So we have not seen this concentration in a specific sector or even the top 10 names of the S&P 500 ever, or in a very, very long time, I think it's actually ever, that we've seen this concentration. So we do take on quite a bit of risk in having that much exposure to one sector. Certainly technology, we're in a new world right now, and technology is very exciting, but it's not cheap by any means. No. It's expensive. Now, we have to marry that with the fact that the earnings growth is very strong, but how far will we allow PEs and price to sales metrics go in terms of uptrends before we realize it's a bit expensive? So selectively, we do like technology, but I think that when you're buying this index, it's not as safe as it was 10 years ago, just given the concentration in specific sectors and very specific names in the top 10.
Okay. Bali now calling in from Newmarket with a question. Hi, Bali, what's your question?
Hey, Stan, it's a pleasure to have you in today. So my question is, specifically around Shopify in the long run, because it's given a long run. Do you think it can double, in the next 12 months amidst all of this, China tariff play, which is going around, and a small generic view on, with the Bitcoin update, the last quarter results of MicroStrategy, they talked about their business, right, which is where they saw growth. So with their entry into S&P, do you think that stock can also double? So those are the two questions I have. Sorry, Stan, I got two questions for you.
Okay. Thank you for those two questions. Shopify doing really well. Yeah, one of the questions is, do you think it could double? You see that happening?
Look, Shopify is a fantastic business. However, it's done very well, I think, in part due to the fact that it's one of very few names in the technology space in the TSX. Mm-hmm. Others being Celestica and Constellation Software and so forth. I kind of worry about the valuations for Shopify. Now, from a technical perspective, the stock is doing well. It's moving higher, higher highs, higher lows, above the 200-day moving average. However, it is trading at 3 times plus PEG ratio. So PE is about 90 right now. Forward PE is about 90, and you're seeing about a 30% growth rate. So the PE is right up there. If we see any hiccups with the earnings growth rate going forward and it doesn't meet expectations, this stock, I think, has a bit to fall. So again, I think the name is great. However, I think when you compare to other mega cap tech names in the US, you can find better risk-adjusted names. So Shopify, I think, great names, certainly has done well over time, but I think that from a valuation perspective, you can find even bigger names, obviously, in the US, and stronger names and better risk-adjusted valuations.
Okay. We will be back with Stan Wong of Scotia Wealth Management, taking your questions on North American large caps and ETFs right after this. Here's how you can reach us. We'll be back in a moment. Welcome back. We are going to go straight to the phone lines. William is calling in from London. Hi, William.
Afternoon. By the way, my daughter enjoys working with Brandon at your office. What would you recommend buying in the silver stock area?
Okay, yeah, we were just talking about silver. You like silver?
I like silver. Thanks for the question. So in that space, I actually like physical silver just because you get away from problems with mines, problems with management, and so forth. And if your expectations that we're seeing, for me, I think that the gold to silver ratio is overextended at 85 or so to 1 in terms of pricing. I like the silver bullion space. Now, of course, you can buy equities. So I'll answer about the equity. One name that we do like in the equity space would be Pan American Silver, PAAS on the Toronto Stock Exchange. However, in the bullion space, I like SVR Toronto, which is the iShares Silver Bullion ETF. If you got US dollars, you buy SLV and the US Stock Exchange. That's the iShares Silver Trust. They're the same thing. They're up 38% year to date and 47% year to date. So, 41% each year to date. So they both have performed very, very well. SVR is a hedge version, so you're just getting the price of silver. You're not going to get the lift of the US dollars moving higher, but you're not going to get the depreciation of the US dollar has moved lower, which it has so far. So I like those two silver bullion ETFs, and if you're looking at equities, Pan American would be my top pick.
Okay. Anita calling in now from Markham with a question. Hi, Anita.
Good afternoon, Lindsay. Good afternoon, Stan. My question is on CN and CP. I hold both of them because they were such defensive stocks. I've been holding them for quite some time now, and I don't see much growth in it. And the dividends are not much to be talked about either. So I just need your thoughts on this, please. Thank you.
Okay, CN Rail. Thank you, Anita. CN Rail or CP Rail. We've got a chart of both of them here and how they're doing. Which one would you hold both, sell one? What do you think?
We hold neither.
Okay.
It's not a space that I'm overly interested in at this space, just given the soft sort of environment that we're in Canada. As you know, Q2 GDP was negative 1.6%. If we were to have to choose one, CP Rail would be my choice, just given the fact that it's a bit more diversified in the U.S. and Mexico. Of course, given its merger with CP, now it's CPKC, Kansas City Rail was that about a year ago or so. So I would choose that one. With that being said, I don't like either name right now in the industrial space.
Why is that?
Again, I think with Canada, the economy being a bit softer,
right.
Freight is a little bit softer as well. Tariffs is definitely an issue that's affecting rail companies as well, in terms of lower volume of shipments. So for the time being, I think you want to own rail companies sort of more earlier in the economic cycle, and we're not in that space now because they're a little bit more leveraged to the economy.
Okay. Keith now calling in from Brampton. Hi, Keith.
Hi. Thanks for taking my call. Stan, can I get your thoughts on CBS? Thank you very much.
Thank you. CVS, what do you think of that one?
Certainly a turnaround story with CVS because it's one of the worst stocks in terms of performance up until recently. In December, it turned around quite quickly. A lot of activist type of shareholder stuff happening with this name, and this name has recovered quite nicely. With that being said, it's not a name in our portfolio. I think the retail space continues to be a bit weak for CVS in the retail pharmacy space. The pharmacy benefit type of area is a little bit better, but of course, I think it's dragged down somewhat by the retail space currently. And really, the stock's been driven by more of what's happening in the activist type of space, which is not really, for me, a great reason to be buying this particular name. From a charting perspective, it is good that it's picked up above the 200-day moving average, and the stock is now above there. And the 200-day moving average is starting to move a bit higher, but it just doesn't show up on my radars, on my radar. And earnings growth is still a little bit tepid at 6.5% earnings growth expectations going forward.
Okay, go back to the phone lines now. Jack is calling in from Montebello, Quebec. Hi, Jack.
Hi. Thanks for taking my call. I'm wondering about Freeport-McMoRan, and it's moved up quite a bit over the last few months, but wondering what the effect of the tariffs on copper might have on it going forward.
Yeah, okay, thank you for your question. Yeah, Freeport dealing a lot with copper and gold, but I mean, with the question specifically about copper and the tariffs, what do you think?
Again, I mean, with the tariffs and the policy around that is always going to be uncertain. We can have an announcement about a tariff today, and it can change next week, as you know. The stock looks interesting. I mean, certainly it's moved up since April. The 200-day moving average has been falling, but at least the price has moved above the 200-day moving average, so that's positive for the time being. So I like this particular space. It'd be great if sort of China really picked up as well, because as a base metal type of company, you kind of need those major countries to pick up their economy, and I think that can really propel this stock. So I think I'm a bit neutral in this particular name for now, but I see signs that we could see a pickup down the road.
Okay, our next question is an email. Lori emailing in, and it reads, could I please get your opinion on Novo Nordisk? Now, you do like healthcare, usually. What do you think?
Yeah, so in this particular space, the GLP-1 names, we still hold Eli Lilly, which has also suffered a little bit, not as much as Novo Nordisk. If you look at Novo Nordisk, after a great run going back a couple of years, it's really been falling quite rapidly. It's below the 200-day average, and the stock price is falling below that 200-day moving average. With that being said, valuations look somewhat attractive in this particular name, but I think the sentiment remains pretty rough. You're looking at paying 14 times forward earnings for about an 8 to 10% growth rate. Really what's happened with this space is they warned, they guided lower for the year, and since then the stock has really been falling. However, long term, I think that the strength of Wegovy and the fact that it's shown to cut risks in heart attack and stroke, and now these two drugs are being used not just in obesity medication, but also for liver disease as well. Those are great catalysts long term, but I think it's really about patent cliffs and pricing risks and competition and compounding pharmacies that are coming that have sort of threatened companies like Novo Nordisk and to a certain degree Eli Lilly. So I think valuation-wise, it looks interesting. I think the market in the diabetes and the obesity market is still very, very attractive long term, but we just have to see how this competition and the copycats and the compounding pharmacies will play out over the next little while.
Okay, that's it for calls today, but don't go away, of course. Stan will share his top picks coming up right after the break. Join us tomorrow on Market Call. Richard Fogler will be on the show. He is managing director of King West & Company and will be taking your questions on North American equities. And if you missed Market Call, you can always check out our daily podcast as well. You can find it on iHeartRadio and other platforms. And you can also watch full episodes on our YouTube channel. And time now for our top picks with Stan Wong. Stan, let's take a look at your first one. Everyone knows Amazon. This is your top pick. Why Amazon? I mean, they're investing heavily in AI, as you say.
Yeah, absolutely. So global leadership in the e-commerce space, of course, and cloud infrastructure. AWS is #1 in the world. Growth engines continue to be very strong. Fiscal 2026 revenue is projected to be near US $780 billion. Prime membership is over 250 million people around the world, and margin expansion. If you look at advertising, when you get those ads, when you're buying something on Amazon, you see the top ad at the top. That's advertising. That's a very high margin business for Amazon. That's helping earnings growth continue along. And they're putting a lot of capital into AI with robotics and global data center infrastructure as well. That's going to help them be more productive and increase their earnings as well, and reinforce their leadership in the cloud services space too. And strong results. Recent earnings and revenue have beaten expectations. Retail margins are improving as well. Advertising growth, as I mentioned, has been very strong. You're paying 33 times forward earnings for EPS growth rate above 17%. So premium valuation, but there is no other Amazon out there. And they're at the brink of sort of breaking out like other mega cap stock names have. They haven't done that just yet on the technical charts, but they're about to, I think. So that could lead to much higher prices as well.
It just seems like nothing can keep this company down, right? Like tariffs haven't really affected Amazon that much either.
No, it has not. And I think that they are very adaptable and they're very flexible. And there's lots of retailers out there that want to sell through Amazon.
Okay, next pick is Cardinal Health on the New York Stock Exchange. You like this one, obviously.
Yeah. So when you look at Cardinal, we also own McKesson, which is a similar in the similar space. I mean, they're one of 3 major distributors in the health care distribution space. Those 3 companies, Cardinal, McKesson, and Cencora, control 90% of the U.S. pharmaceutical distribution space. Revenue growth, we're looking at about $250 billion by 2026. And long term, you look at the secular tailwinds, which is really the demographics. You have an aging population. We know that prescription drug usage will continue to grow. People are taking 1 or 2 drugs today. It's going to be 3 or 4 in the future. So that's going to be more utilization, more growth for a company like Cardinal. There's going to be more movement from Pfizer to Walmart and CVS and so forth, and that's what Cardinal does. It trades at 16 times forward earnings with 13% EPS growth, so it's nearly a 1 times PEG ratio, so pretty cheap. It's a low beta stock, so one aspect of that is that when you're building a portfolio, you can't have all high flyers. This is a low beta stock. It gives you a consistent earnings growth company. Stock is down a little bit because they bought a company called Solaris, so I think there's an opportunity here.
Okay, so you like tech and you like healthcare, so I wasn't too surprised by your first two picks, but the next one is DoorDash. What is it that you like about DoorDash?
DoorDash fits this on-demand theme that is around the world and is growing right now. It's, I want something and I want it as soon as possible. And it's that last mile delivery that has been very, very difficult for companies to get their products from their hands to the consumer's hand. DoorDash commands 65% of the U.S. food delivery market, which is astounding, and they are expanding very quickly into grocery, alcohol, convenience, and retail, and obviously into international markets as well. They are the leader in digital convenience. It's all about convenience. It's all about on-demand economy. And that last-mile logistics, they are very good at that and getting things into the consumer's hand very, very quickly. They've got strong brand recognition. Their commercials still ring in my head all the time. And revenue growth, we expect 2026 revenue to top $16 billion. With, you've got very high margin opportunities with their DoorDash subscriptions and their advertising. So similar to Amazon, if you want to order something, sometimes you will see those particular restaurants be at the top of the ad or top of the page, and that's advertising. Margins are improving. We see 25% plus earnings growth going forward for this company and double-digit revenue expansion. So I think there's major secular tailwinds as people, there's more urbanization, people moving to cities, people wanting to order things and get things in their hands much quicker than, next day or something like that.
It's that instant gratification, right? Everybody's into that nowadays,
and
of course.
that's what we see with Amazon. We want to see Amazon Prime, we want to see it tomorrow.
Just quickly, because we do have some time, I noticed with DoorDash and a couple of your other picks and your past picks, they don't have dividends. That doesn't seem like something you're too concerned about.
So my approach is always looking at total returns, and certainly dividends is part of that return. If we have dividends, that's great. But we don't want to be chasing exclusively just looking for dividends, because sometimes you'll get a company paying 5% dividends, but the stock price is down 15%. So it's very important to me to see earnings growth, because earnings growth can lead to future dividends, but more importantly, it leads to reinvestment and more capital appreciation. So it's not that we avoid dividend stocks. Dividends are great and they're important. They're one factor, but they are only that. They're just one factor of our investment style.
Okay, good to know. Stan, so great to have you. Thanks for
Great
coming
to be
in.
here.
Appreciate it. And thank you for watching Market Call today. We will see you next time.